You are watching when it's live.
Hello everyone and welcome to our webinar, Tough Contract Clauses, How to Protect Yourself as an Angel Investor and How to Help Protect the Founders. My name is Sarah, I'm from Angel, and I'm very happy that all of you showed up today to dive right into this very interesting topic. Today is going to be a very interactive webinar, so start asking your questions right from the beginning. There will be no designated time for Q&A, so we will just try to answer all your questions throughout the whole webinar. Before we start, I want to welcome our guest Paulo Bandeira. He is a partner at SRS Legal for corporate law and very experienced with startups. He's also a business angel himself and is director at Investors Portugal, the Portuguese Association for Early Stage Investors. Also on stage with him are Falcão and Pedro Bandeira, my colleagues at Angel, but they also founded Red Angels and Core Angels together, so are also very experienced angel investors. So I would say, let's just jump right into the topic and welcome everyone to today's webinar. So are also very experienced angel investors.
All right. Thank you for coming. Thank you, Paul. We will today be talking about the top clauses, about investments of angels in startups and the next rounds, and the ways we have to not only protect the angels, but also for us to help protect the founders in next rounds. So it will be more like a conversation, but we have people watching. That's the difference. But it's not a very structured interview or something like that. Just for us to be okay with that. So we know that some angels can do good investments, like selecting the startups. The startups are just rising and they are doing great. But in a moment in time, a good story turns into a bad story. And for some reason, the good investment is not a good exit. And we can discuss why that happens, but also what can we do to avoid those problems. So to start the conversation, should we understand what can happen to angels in next rounds and in the future when they don't protect themselves in contracts, in investment contracts.
Thank you, Pedro. Good afternoon. Good afternoon. It's great to be here. Thank you for the invitation. We need to prepare. So that's I think the main message that one can pass. We do understand that venture capital is a risky activity, and we, as an angel, when investing in startups, we actually invest our own money. And so we do understand that in this environment and the ecosystem, still 9 out of 10 startups fail. Hopefully 8 out of 10 with the strengthening of the ecosystem and the professionalization of all the parties in the ecosystem. But that's the first message that one must have when we enter this game. So it is a risky activity. In order to de-risk what we do as angel investors, we need to prepare ourselves. And to prepare ourselves means to correctly evaluate the companies, but also to prepare in terms of contracts and to establish what are the right clauses and the necessary clauses for the contracts to protect the position of the investor. That does not, of course, assures 100% effectiveness, because it really depends on how well the company will go and will the startup be successful or not. But still, there are ways of de-risking your position. And first of all, you need to understand what are the ways of the practice. And so what is common in angel and VC investment. And if you can actually fully understand that, you can better position yourself to do it.
So you're saying that, one coming to angel investing and just building their own contracts, not being aware of the standards of the industry, that's one of the mistakes that you're saying
that is one of the big risks. So make sure you understand how it is done. Venture capital and business angel investment is completely different from traditional M&A and private equity. It's a completely different ballgame. It has its own jargon, and so people need to understand that investors enter at somehow high valuations for companies that are very, very in their beginning. And so that means that the way that you usually value companies does not work with startups. So that's the first message. And of course, because they have higher valuations that are not linked to what they sell or to what are their returns, you as an investor will end up with a minority stake because, of course, you are putting your money in more than the company on the business idea and mainly on the team.
Right. So, Rui, you as an angel, a very experienced angel, what if somebody is starting their angel career and starting investing in startups and asks you, what can go wrong? What do you say?
Whoa.
What if somebody is starting their angel career and starting investing
So
in
many things
startups
that can go wrong.
and asks you,
But
what can
I
go
think
wrong?
to frame a little bit this question, I think it's interesting to see that the mindset of the entrepreneurs and the mindset of the angels, particularly when we are in the very, very early stage. And normally the business angels are not so focused on trying to understand all the situations that will happen later on when they exist. They are much more focused on trying to understand if it makes sense for them to support the entrepreneur, to help this idea to go, and contracting compared with traditional VCs, it's not a priority. So our priority is much more on the project, much more on the very early stage, on short term. And we don't think normally on the later term. And we do also another mistake that normally we delegate in the later investors, in the VCs, the things related with the contracting, the term sheets, and all the things, and sometimes we have some surprises, and that's the point.
Cool. So we neglect that part, and we can say the same for the founders. So the founders also neglect a lot that contracting part, and they can delegate and somebody to do the job, but they don't really have the time or the commitment to go deep on that and understanding all the clauses and to protect themselves. So what can also, because we as angels, when we invest in a startup, we are not only looking for our exit, but we are there to help the founder to have a success story, and we want to be part of that success, right? So when we, I see a lot of startups that want angel investors in the first round because they want somebody to be on their side when they are negotiating with the VCs on next rounds. So the question is, what can we as angels be aware of to help the founders to protect themselves in the first round so they are prepared for the next round? What do you see as what can happen to a founder even if the startup is going in the right direction? What can happen to the founder that can make a success story into a bad story for him or her?
Yeah, so I think one very important thing is that the angels must think much more in the long term. So that they need to be aware of what are the next steps, and need to align with the founder, also to coach the founder, also to help the founder, because normally the founders and the angels are in the same type of classes of actions of shares. They are aligned normally because they are very early stage investors, and the problem normally comes on this industry with the methodology, the idea that the last investors as the priority of the investment. So the problem is about this situation. So, and we need to prepare and to learn and to be aware and to do this pedagogic approach with the entrepreneurs and create that trust and that alignment to be regarding the development and the cycle of investing in a startup and all the situations that can occur related with the funding. So have a funding strategy and a preparation, a more long-term preparation for that.
Oh, founder related. What do you see that founders are not aware of, and they should do to protect themselves? What do you see that can be the main problems for founders in the future if they are not aware of contracting?
Well, first of all, let me just say that I totally endorse what Rui was saying. So there is a huge difference between what is the type of contracting that business angels do and what the VC industry does as a standard. So angels are typically more relaxed in the way that they contract their initial investment with the company. We do understand that we enter very early, and so sometimes, and most of the times, we actually don't know if the company is going to be successful or not. And when VC comes in, the company is more structured, and so that's when we see the contracts, more structured contracts going in. So the first thing as an angel that we should consider is that we should structure contracts earlier. So we should probably, in that sense, learn a lot with the VC industry. And to better protect ourselves, structuring the contracts, and also making the pace that will actually allow for the next contract to be better negotiated and drafted between the company, the founders, and the VC that will enter later stage. Regarding the founders, it's crucial that they do understand how the VC industry works and how the angel investment works. So, like I was telling about, there is a lot of jargon in this industry. This doesn't work like traditional M&A, and so there is kind of an unbalanced position between investors regarding the investment they made and the stake in the company that they hold. And that unbalanced relationship will be balanced or will be even by the contractual mechanisms that the investors put in the contracts that will bind the parties.
So you're saying that if we invest in a startup and we put most of the money, but we keep, a little percentage of shares, we are not being protected enough. We need to balance that, even that relationship with the founder, with other protections for the investor to compensate that, right?
You definitely need to protect yourself because you are putting the biggest chunk of money for the company to deploy, to develop its activity, but you end up with 5%, 10%, 20%. And so in a normal company, 5%, 10%, 20% does not give you any right whatsoever. And so you don't have a way to impact management. You don't have a way to object to any kind of decision. You don't have a way to receive more than your shareholding position. And so that's what the contract regarding investment will try to balance. So and this is what also founders need to understand in order for them to better negotiate the terms. Because terms can be normal traditional, or they can be aggressive, or they can be soft, and that also really depends on.
And sometimes you just change a word, and it is
everything changes.
Everything changes.
Everything changes in the position in which you are, and also the terms of the investment of business angels and VC industry has changed in the past 10 years. So, just to give you an example on liquidation preference, and for those that are listening and that are not so familiar with that, liquidation preference is the ability for the investor, whenever there is a sale of the company, to receive the money first and to get paid first than the other shareholders, including founders. There was the normal way in the industry 10 years ago was to have multiples in liquidation preference, and so with the higher valuations that were got in most of the transactions, that smoothed a lot, and multiple by definition disappeared. That does not mean that they will be away forever, so they can return. So, but founders also need to understand that investors will require from them veto rights on certain decisions on how to use their money. They will request anti-dilution mechanisms regarding what will happen in future rounds and what will happen if there is a down round. So they need to understand what the down round is. They need to understand what the liquidation preference
is. But the founder is not thinking about that in the beginning.
The founder is not thinking about that in the beginning, but reality will probably show that when money is gone and you need to raise further money again, and you are in a rush, and the market conditions probably are not so fit to raising money at that time, sometimes you will end up raising at a lower valuation. So you need to understand what is your position when that comes. You need to prepare in advance, and you need to have your contracts right. Otherwise, you'll not only raise at worst conditions, but most of all, most likely, you will end up with worst contractual positions as well.
I already know your opinion, but as angels, we join a startup, and we have a lawyer with us, but the founder is alone. I already know your opinion, but what should we say to the founder? Should we, negotiate with the founder directly, even knowing that we are not in a balanced negotiation? Should we, force the founder to have a lawyer with him or her? Or what should we do to guarantee that in the end, not only, we can have good intentions when we are investing, but we want to make sure that when we are negotiating, we are not being aggressive or passive, but we are being fair with the founders. Not only,
we all need to build trustful relationships, especially when negotiating such an important thing like a contract or an investment contract. My advice is that every party should have a lawyer. And in this case, it's not just a lawyer, it's an experienced lawyer in investment, in startup deals. Because like I said, there's a lot of different things regarding traditional corporate and M&A. And there's a lot of jargon and a lot of different instruments that contracts will depict that actually the parties need to understand. Again, if a founder does not understand how a liquidation preference works, or if he doesn't know that multiples are basically not so common these days, he will end up accepting a situation, or probably accepting a situation in which, whenever the company is sold, will make him receive less money that he probably should be receiving. So definitely, both parties should have a lawyer. If that's not the case, of course, full transparency and full explanation in order to build trust. Because at a later stage, probably we will get a lawyer, and probably at a later stage, stage you will explain what went wrong with that contract, and probably at a later stage that will deteriorate relationship.
And sometimes you have the possibility to change things and to correct things, but sometimes you have not, right? Because the things are already there, right?
It's always difficult to change something that's already established without creating an adverse relationship between founder and investor, or even between investors.
Rui, what's your experience with that? That happens in next rounds, and when that relationship is not balanced between the investor and the founder, that you can say to the founders that or the angels that are helping founders. What's your experience with that? That happens in next rounds, and
the startup is
when that relationship
very,
is
very,
not
very
balanced
important
between the investor and the founder,
for the entrepreneur.
that you can say to the founders that or the angels that are helping founders.
In a certain way, the investment is also important for the angels. But why? Because of the startup is so important for the people that believe when they are just beginning, and they dedicate so much time to them. That's why that's so important to defend the startup. However, there are many aspects that we need to protect the startup, and we have been speaking about protection when there is an exit, or there is a sale, or the startup needs more money, when there is a problem. And this is a type of protection. So the protection, because it's so dramatic that you dedicate a full life to the startup, and at the end you can receive zero. But this is a reality. Even startups that were promising startups, that were developed, having a lot of people, having clients, but for any reason in the middle of the journey there is a problem. They need more money. Quickly money, and this is a problem for the startup. But the protection, so there is a type of protection related with the shares and the potential of the money that you can receive in the future. But there are also some other types of protection. For example, I think we angels need to help the entrepreneurs to protect the startup even from himself or herself. Because sometimes when you begin a startup, you do the startup with the friends, with other founders, with other co-founders, and in many times they are not the right people. They are the right people for that moment, but time to time you need to change. You need to invite another person to the journey, and you need to give the startup the possibility to do that. So this is another type of protection that we can prepare the founder. Maybe is good at a certain type as an entrepreneur, but at a certain time, maybe it's better to have another person that probably is better than him, and he need to be prepared to do that. So this is another layer of protection, and we need clauses to help on the protection of himself and also the other co-founders or other people that are in the process of
that's a very interesting topic, because usually if you say to the founders that, okay, you created the company, now I'm coming in and your shares will be vested, so you'll have that, so it means that you're not owner of your shares right now, you will gain that ownership over time. And this, sometimes you have a startup with 3 founders, and one of the founders is just quitting, and you have a silent founder that has some shares there. So can you explain how that works to solve that issue of a founder just leaving the team?
Yeah, so that's one of the most important, actually, along with liquidation preference, that's one of the most important topics that levels up the relationship with investors and grants some rights to the investors. So I always try to be pedagogic at this moment when I explain to founders that this is a heavy investment for the investor. And so, like I told before, the money is put in the company, but actually you are investing in the team, and you are investing in the business idea that's going to be developed by that team. And so, if someone of the team leaves, that is a huge financial impact for the investors, because ultimately you need to find out someone else with the same know-how, with the same capability, with the same capacity of developing commitments. And for that, you need not only to provide money for those persons that you will be hiring, but also you need to put some flesh in the game. And so they need to have a harder commitment, and probably that means giving them shares. And so they need to be part of the company. And you cannot do that if you have someone holding a big chunk of shares, being passive in their position in the company. And so vesting is one of the most important things. It's actually one of the most difficult things to explain to founders. The ones that are not so familiar with the investment thesis in startups, they actually feel it's unfair because they will be giving up some of their shares, but it's actually something that will benefit the continuation of the company.
And it will protect the investors, but it will also protect the founders that keep in the company, keep working in the company, right?
And that's actually more protective to the other founders, to the investors itself. But yeah, so that's one of the definitely situations that you need to have in the contract in order to protect the investor. You need to have vesting, and you need to have a firm commitment from the founder that he will remain in the company for a certain period of time.
Okay, what do you both saw in contracts that you can call toxic terms or abusive terms, or something that is too harmful for the early stage investors?
Should I start? You start?
Well, I see one or two that I'm dealing with so many times, but sometimes for example, the question of the governance, for example, the governance of the company, what you can do, what you can't do, and the leadership of the company. So, for example, it relates with control, but it is a little bit strange. For example, that if the majority of the shares are in the hands of the entrepreneurs, why are some minority investors that have the control of the company? The how and why that control can be can happen, and the concrete situations in which there are freedom and autonomy to have decisions, and is very important for the vision about is this company who belongs the company belongs to whom, and this can create situations of conflict, of demotivation, and also in a certain way abuse of power of some eventually investors.
You're talking about like the way we design the boards, the board seats, who has the right to nominate someone to the board, or veto rights,
contracting, autonomy for doing the plan, autonomy for execution. Suppose this is something that already happens, and sometimes, for example, there is a plan, and the question is maybe flexibility. Normally, the entrepreneurs, mainly in the early stages, are in searching the best way to develop their startup, and because of some contracting, there are some impositions about what should do, what not should do, and where would be the focus. And maybe there is
so if I'm putting my money in, you should do what is in the plan. That I'm buying the plan. I'm not investing in you. I'm investing in the plan.
So you buy the plan. You buy the plan. You buy the execution. You pay for the execution of that plan. And sometimes what you need is to be paid for the search, for the discover, for the validation. Maybe you will find something even better for the problem that you are solving. And because that mindset that the entrepreneurs are focused on in a solution of the problem, and the investors are sometimes in obtaining returns for their multiples, there may be a conflict between solving a problem and obtain my returns as soon as I can. And this can be a conflict that can put the company in a conflict between development of the company and the returns of the investment. There sometimes can be two completely different things.
All right, Paulo.
Yeah, Rui's absolutely right. So one of the things that actually is one of the majors in terms of negotiation of shareholders agreement is basically the veto rights attached to the investor position. And so we need to be careful on how to draft that, because ultimately you don't want an investor to paralyze a company. And so, and in that sense, I believe actually business angels are more flexible than VC industry, which have more veto rights attached to that. And so that's one thing. Another thing that we sometimes struggle is the ability or not for the company to do further share capital increases with or without the investment approval. And should there be investment approval if we are talking about a higher valuation? Would it be necessary or not? So this is something that is also commonly discussed. If you want to discuss heavily aggressive situations, I would say that some that were slightly common in the past were multiples on liquidation preference. So the ability of an investor to receive, whenever there is a sale of the company, a multiple upon its investment, and then again a pro rata on its shareholding. So
can you just put some numbers on that, just to make sure that everybody understands?
Yeah. So for everyone to understand, if an investor invested 1 million in a company and the company is going to be sold by 10 million, if he had a 2 times multiple on liquidation preference, regardless of whatever he had a shareholding in the company, he would receive a minimum of 2 million, and then he would still receive the pro rata of its shareholding.
What happens if the company is sold by 2 million?
He gets everything. So
and the founder nothing.
And the founder receives nothing. So that's why actually currently the ecosystem has leveled this down, and most of the times we see non-liquidation preference non-participating, and so the investor has to choose between receiving whatever he invested or what comes out of his shareholding in the company. But you can also have, and this is our extreme and very rare, you can also have situations like down rounds on which an investor could impose a down round. You can have aggressive drag-along clauses.
What's an aggressive drag-along?
It's a drag-along clause.
First, what's a drag-along?
A drag-along. So a drag-along is the capability that an investor or a given shareholder with a certain percentage of capital can sell your shares whenever there is a proposal for his shares to be sold. And so we can drag you to sell your shares as well.
Forcing somebody to sell.
Forcing someone to sell your shares.
What's aggressive?
Aggressive.
That's standard, right?
Yeah, that's currently standard in the industry. Okay. What is standard is that you can drag whenever more than control position is reached. And so if someone holding more than 50% or more than someone of holding more than 50% wants to sell, these shareholders can drag the others. Okay. So that's currently standard.
What's aggressive?
Aggressive is less than controlled situation. So if you have someone with 30%,
so you have 5% and you can drag 95% with you.
Definitely extremely aggressive.
Okay.
But that is also linked to other things like mandate to sale. And so we business angels don't have that issue because we invest our own money. And so we don't have, unless we are organized as a fund, we don't have fund limits, but VC investors that actually funds have limits of time. And so it's normal to have mandates to sell.
We have our limits.
We do have our limits. We need to exit, of course, like everyone else. But funds, VC funds have these limits more strict. And so you need to negotiate a limit for a mandate to sell that is reasonable, 5 years, 6 years. If you do it very on short term, everyone's going to sell it very badly.
Yeah, I see. Okay. So, we started by understanding which are the problems that can arise for angels and for founders. We are now understanding what's aggressive and what's standard. But my challenge to you is also to think about what can we do in the future, being creative. What can we invent to the future to innovate this industry, the contracting, that can make this more fair in the problems that we are identifying.
Oh, I have some.
You have some
ideas. One idea that we need to begin to discuss also the investment process from the ethical perspective. So the business can be to be a good business. Need to be a fair business for many people, for all the people that are interested on that business, because if we have a long-term commitment with this industry, with the business, you need to create good references, good impact, and good good practices of doing that. And I think we need to discuss the funding and many other aspects related with the survival of a startup with the different stakeholders. So we need to involve from the beginning. For example, from the funding, I think we could have long-term views, more long-term views on the funding process. So maybe we need to create agreements regarding the different stages of the startup. Understanding that the startup need money not just for a short term, but also preparing the startup for a long-term view, and have agreements with different business angels, with venture capital, with the family offices, and to create a culture, a fairness on the process, and to create the process. Also, to avoid the abuse, for example, we see that different players can have different roles in the process of growing of a startup. And for example, the business angels are much more important in the first phases, in the early stage, than in later stages. So why should they be in the later stages if they are not relevant there? So they should exit before. Should we preview that the early exits? Should we contract eventually early exits in order that economically makes sense that when you create value, after you create value, you go out and you can have a substitution for other type of investors that add more value in later stages?
So you're bringing two things to the table. One is the early exits of angels not being until the home run. But the first thing is, alignment in the long-term vision with the founders and the other investors. So I will use that opportunity to bring in a question from our audience. But how can you prevent an injustice? How can you even predict that there is always someone better? The question is not about motivation. So the question of how motivate entrepreneurs in hard times. So that's one side of the question. And then we have another side, which is how do you assess the cultural fit that comes to what you're saying? How do you assess the cultural fit between the founders and the investors? And what measures do you take to ensure alignment of values and long-term objectives? How do you do that in the beginning? And so we have two things. One is the motivation thing, and another thing is alignment. How do you assess that cultural fit in the beginning? You both. Yeah. Take that, easy one.
Yeah. No, I think this is one of the most important things that, of course, and angels particularly are not only financial investors. So, contrary to some type of financial investors that invest for the money, and that's okay, invest for the money. That's a good possibility, but when goes to business angels, they can have other type of reasons for invest, and one of them is to look for the alignment between with the founders, and beginning from the beginning. So in order to
but how do you assess that? You can have a good technical founding team, a good idea with a huge market opportunity, everything is good, but how do you assess is if you are aligned with the founders to avoid future problems? And that's hard, right?
Yeah, but I think that you should talk a lot with the founders, and know the founders, know what are their values, putting questions and scenarios, eventually creating this type of confidence and knowing each other. Because if you also know more each other, what are the expectations, and you put that on the table from the beginning, it's much more honest, and will avoid you problems in the future. Regarding these type of things, for example, should we go together until the end of the journey, or should we exit before? Or if you have an opportunity do you leave the company and another opportunity when you earn more, or do you continue in the company? What makes you consider another project, and have a fair talk with the people to understand? So I think dialogue, it's very important to create conditions to understand if there are a common values shared.
I usually say, Paul, that fundraising is not about negotiating, but is about dating, because we are not there to understand the way to marry is to understand if we are going to marry or not. What do you think about that?
It's more than that. It's actually if you stay married for many years. So I usually say that fundraising is an art. It's the art of dating, actually. And you need to get everyone aligned with this process. So the first thing is very important for the founders is that money is not the same everywhere. So you can get the same amount of money out of different people, and that does not mean the same thing from everyone, each of them. For some, money is just money. For others, it's money with attachments, and for others, it's money with obligations, and for others, money with opportunities. So the first thing founders should do is actually assess the type of investor you have in front of you. It's okay to get any type of this money. You just need to fully understand what you're getting in order that you can make the most out of it. The same goes to angels and VCs. So like we were saying, founders are not the same. And so we need to understand what type of founder do we have in front of us. Thankfully, there is a lot of professionalization, both in startups and angel investing in the past few years. And we do a lot of assessment of each other's on more and more often. And so that decreases the risk of both parties having a misalignment in the future. But it happens. It definitely happens. And also at a later stage. So we need to understand what are the VC investors that will come afterwards. And if we have a good fit with them. If the company has a good fit with them, if they are the correct investor for the company, if they actually have a purpose on that vertical that the company is developing the product or not, or if they are the best ones that will help to grow on an exit afterwards. But also if there is this ethical relationship between the VCs and the previous investors that are already in the company. Because if there is this alignment between all the parties in the process, for sure we are de-risking a lot this path that it's not certain, and it doesn't mean that's going to be successful at all. So for sure we need to think, like we were saying, if it has merits to stay all the way along the way until the exit, or if you should leave early. And
what do you think? Should angels, go for the home run, or plan early exits?
I think we need to have, like everything in life, a balanced strategy that encompasses both of the situations. So we definitely need to understand that for some of the startups, we probably will go to the home run because it makes sense. For some of them, and actually to enable probably faster investments and early investments also in other companies, we probably need to leave early and to get some liquidity out of those investments early. Of course, that early exits means lower returns. And that's okay if it is strategic on the way that you do it. If we could always go toward the home run, that will be supreme and that will be a must, but that's not always the case. So we need to find ways, which is not completely to this moment, it's not understood by the VC industry. So we need to build up this education also in the industry. But we probably need to structure in the contract, build up in the contract clauses that allows for angels to leave early, if that will be the case.
What do you mean?
I mean call options by the founders at a certain multiple, or put options dealt.
What's a call option and a put option?
Okay, call option is the rights for the anyone to buy you out and to get your shares at a certain point, or a put option is the ability that you have to force someone to buy you your shares, or to establish. I'm not a fan of multiples in liquidation preference, like I've told you before, but maybe it makes sense for angels to structure that, because that allows to not to get to the home run, but to leave early the company with a fair return, without being too onerous to the other shareholders that will stay until the end and will benefit the most. Or actually, and this is not typical at all, to have kind of hybrid instruments, like investing part in equity and part in debt, that will allow you to get repaid at a certain interest or multiple or whatever at a certain point in time, and then stay with a small amount of your investment until the end. And so you de-risk your investment as an angel investor. You allow yourself liquidity to have investment in different startups, and you can stay to see if there's going to be an happy ending or not.
Right, and sometimes if the angel invested 100K and the startup now raised 5 million, paying the 100K to the angel, or 2 times or 3 times that, is not relevant in the amount of money raised by the startup, but it can make a huge difference on the entire industry, because that money will serve to invest in new startups that will grow and will become ready for those VCs also to invest, right?
It's an affordable investment to the shareholders, actually allows the VC investors that came late to clean up the cap table and will optimize their returns afterwards. So I think there's path to be done there in the discussions.
Okay, this webinar is not about exits, but when we are talking about contracting, we always come to that. And which are other creative things that we can do to avoid those problems or to facilitate our investment and our relationship with founders and the other investors?
I also think that the problems are not only from the part of the investors. Sometimes we need to protect the investors from the founders, and because some type of these aggressive clauses also happened because there were some type of behaviors that make the investors to lose a lot of money too. So there, the bad guys are not the investors, or the good guys are the entrepreneurs, or whatever. There are good guys and bad guys
everywhere,
in every process that can happen. So the thing is, should we have a type of fair contracts where the value that the entrepreneurs create with the support of the angel investors and the investors can be shared in a fair way? Can we move to another type of contract that can be a clear, balanced contract? Could we create a culture of balance and fairness and teach that on the incubators, in the acceleration programs, in the universities, on entrepreneurship? Could we go deeply to understand the complexity of the contract, but with the idea that sometimes we are not pushing for our side, but we are pushing for the company in a way that is fairness? Because normally, if you have a contract that you push too much for your side, in the future, maybe you will have problems.
Yep.
But if you are a lawyer, Paulo, but I don't know if you have this experience. If you sometimes you can put yourself in the feet of the others, you can come to a balance type of contract that normally it will be better for the future and better for all.
Right? I think it's you are completely right, but it's more than that actually. Getting returns and exits in startups is moving on thin ice most of the time. So, like we told in the beginning, 9 out of 10 or 8 out of 10 they fail, and so in order to leverage and to make sure that these 1 or 2 are going to exit and to be successful, we need to be all the agents in this path need to be aligned. And totally, if you establish a very one-sided contract, regardless of the position that you have, you will probably end up in a situation in which, when you want to sell, the one that is felt that his position was being unfairly beaten will react at some time, and so that will create later on a position which will be hard to manage to everyone else. So furthermore, that creates disruption in the ecosystem. If you want to build a strong ecosystem, you need to be ethical and transparent and fair in all the positions that you take throughout the investment, especially in small ecosystems like this that we have. And basically, we are all fated to work with each other because ultimately you will end up seeing this investor or the other founder raising again later on. So make sure that you listen to the other, you understand what are the bases for his actions, investment, or to fundraising, and make sure that you reach a fair and amicable agreement that will work both ways. Because if it doesn't work both ways, most of the times that startup will not reach to the end.
Mm-hmm. Cool. Yeah. Cool. So we don't have infinite time to be here talking about that. So we need to finish. But just bringing another question for the audience about the drag-along. Under what circumstances might a drag-along clause be triggered? And what thresholds or conditions typically need to be met for it to be enforceable?
Well, like I told, drag-alongs usually are pretty drastic. So basically, you can force the whole organization, the whole shareholders in the organization to sell. So you need to make sure that you have a majority alignment of the shareholders in order for that to occur. So drag-alongs should not, in any event, work if there is not a majority will to sell the company. Okay, so that's stage one. Stage two, probably there should be a minimum threshold for you in terms of value of the company for you to sell. Otherwise, you will be harming someone, either a late stage investor or an early stage investor. You need to also, because drag-alongs work with liquidation preference, and so if you know that you will get all your investment, even though the early investors will not get it,
right?
You should not drag.
Yeah.
Otherwise, you will be harming other investors.
Right.
So there should be boundaries on how drag-along works. But basically, the basics is this: so above 50% threshold, and with a minimum threshold that protects at least all the investors, that would be the minimum fair for the drag-along to work.
Yeah, because sometimes a drag-along, in principle, is to protect you from a founder that is not aligned on selling the company and wants to go to a 100-year-old company and leave it
business.
to leave it to the kids and everything. And sometimes I feel that if we spend more time dating, we don't need all those protections because we will be more aligned. And sometimes we just need to put those standard things to guarantee that we are aligned. If we didn't discuss that in the dating time, at least in the contracting, it is there and everybody is agreeing with that, right? I don't know if you have a final message about this, the contracting tough contract clauses that we did not address in our conversation.
Oh no, my point, it's the legal part of a startup is in the contracting is sophisticated, it's complex. So my suggestion and my suggestion for entrepreneurs and also for investors is not to underestimate the contracting phases and to learn more about it, to go much more deeply on understanding the different possibilities that happen, what is the good practicals of the industry, what also to see what's happening in the reality when the founders of startups go into study those cases that with promising companies that come out and they received zero from their investments, and study, learn more, learn with others, and try to protect also yourself by going deeply. It's important to understand, not only put that type of concern on the lawyers, because lawyers, can be from one side, but I think it's important to, if you want to be a player in the industry, to have at least the minimum knowledge about the most important things that can affect you. A startup is the most important thing for an entrepreneur, is startup, and he needs to protect them the most he can. But for that, he need to learn how to protect the startup.
Any final words?
I'll just say, of course, I'm biased by being a lawyer on this. I only think that the lawyer is the best friend for a founder and an investor. So I will just say be prepared. Like everything else, investment in startups is a risky venture. And so like any other investment, just make sure that you play the game if you know how to play it. And so prepare yourself and learn, like Rui was saying very well, understand the jargon and how to de-risk your position.
All right, just finishing. The saying to the founders listening to us and to the angels that are investing in founders, you should, if you are alone, you should go to an incubator or acceleration program, find people that can help you. Don't go alone because, it is too complex to play the game alone. So find people in the early stages that can help you and can be on your side. And for the angels, if you want to start investing as an angel, don't go out there crazy. You can download a term sheet and present that term sheet to good startups that you find. Don't play the game that way because it will be hard in the later stages. So do it well, do it in a group, do it with people that have done it before. And that's my final advice to angels. And by the way, just thanking PCI, the UI incubator from Aveiro University, that helped us with this studio and to do everything. Thank you, Jose, and for helping us on this. So thank you everybody for being with us. Thank you, Paulo, very much for being with us and helping us to think about this and discussing this. We will still be discussing these topics, and maybe we will find crazy, intelligent, and creative ways to solve the problems that we face. Thank you, Rui, as always. And I will give it to Sarah so we can finish. Thank you all.
So thank you, Paulo, Pedro, and Rui, for your insights today, and thank you all for participating in today's webinar. I hope, despite our sound problems at the beginning, you also feel more confident now about this topic. And if you have any more questions, just contact us at office@yangel.co.